Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Hey everyone, and welcome back to Safe Simple Sound. Today we're diving deep into the world of corporate actions and how they impact your investments. Today's episode is based on an insightful article titled Corporate Actions: Understanding How Company Decisions Affect Your Investments on safesimplesound.com website. This article provides a fantastic overview of how major company decisions, from stock splits to mergers, can directly affect your portfolio. It highlights the importance of staying informed about these actions and understanding their potential implications, both financially and for your overall portfolio management strategy. One particularly interesting point was the various ways companies can return value to shareholders, not just through traditional cash dividends. To help us unpack this complex topic, we've structured the episode into three key segments. First, we'll explore the ins and outs of stock splits, decoding their impact with scenarios like the tech giant split, where we analyze a 7-for-1 split, and the reverse split dilemma, which examines the implications of a 1-for-5 reverse split. Then we'll move on to dividends, discussing income and reinvestment strategies. We'll examine the allure of the dividend aristocrat, a company known for consistently increasing dividends, and unpack the special dividend surprise scenario, exploring its potential motivations and effects. Finally, we'll tackle the often turbulent waters of mergers and acquisitions. We'll analyze a mega merger scenario and dissect the complexities of a hostile takeover, considering the impact on shareholders of both the acquiring and target companies. Get ready for an engaging discussion packed with practical insights to help you navigate the exciting and sometimes unpredictable world of corporate actions. Let's start our discussion about corporate actions and their impact on investors. First, we're diving into a specific scenario involving a stock split. Let's say a popular tech company, let's call it Tech Giant, announces a 7-for-1 stock split. Their stock is currently trading at $700, and our retail investor, let's call her Maria, holds 10 shares. Sam and Taylor, let's analyze this. First, does this split actually change the value of Maria's holdings?
So if I understand this correctly, a split is like slicing a pizza into more pieces. You have more slices, but the pizza's still the same size. Maria had 10 shares at $700 each, totaling $7,000. After the split, she'll have 70 shares, which is 10 shares times 7, but each share will be worth $100, which is $700 divided by 7. Her total investment is still $7,000, right?
Exactly, Taylor. The split itself doesn't create or destroy value. It's a restructuring of the existing value. Like the pizza analogy, it just changes the portion sizes, not the total amount.
Perfect analogy. Now, how might this split affect the stock's volatility and trading volume, Sam?
Generally, a split makes the stock more affordable, potentially attracting more retail investors. This increased demand can boost trading volume. Think about it. Previously, a single share cost $700, a significant barrier for some. Now, at $100, it's more accessible. This can also lead to increased volatility, at least in the short term, as more buyers and sellers enter the market. Remember the Apple example from the article we are discussing now? Similar dynamics can play out here.
This reminds me of what we talked about earlier regarding market mechanics. More buyers and sellers could mean price fluctuations become more frequent, even if the overall trend remains the same. Does that sound right?
Absolutely. Increased trading activity can lead to more frequent price swings. However, it's important to remember that these fluctuations might not reflect a fundamental change in the company's value. It's just the market adjusting to the new price and the influx of new investors.
Great points. Now, the million-dollar question: should Maria change her investment strategy based on this split?
Well, since the split itself doesn't change the fundamental value of her investment. Logically, her strategy shouldn't necessarily change, right? It's like if you change the currency you are using, your wealth has not changed. Unless, of course, she had a specific price target in mind for selling, then the target price simply has to scale with the split.
Precisely. The split is primarily a psychological and accessibility play by the company. It doesn't change the underlying business fundamentals. So if Maria's investment thesis for tech giant was based on its long-term growth prospects, the split shouldn't alter that. It's crucial to separate the stock price from the company's actual value.
So, to recap, stock splits increase the number of shares outstanding while proportionally decreasing the price per share. The total value of an investor's holdings remains unchanged. Splits can increase trading volume and volatility due to increased accessibility, but they don't fundamentally alter the company's value or necessarily warrant a change in investment strategy.
If I understand correctly, the main takeaway here is not to overreact to a stock split. It's more of a cosmetic change than a substantial shift.
Exactly. Now, for our listeners, we have a call to action for you. Research the historical performance of stocks after splits. It's important to analyze this with a critical eye, remembering that correlation doesn't equal causation. Consider your individual risk tolerance and investment goals before making any decisions based on a stock split. We're continuing our discussion on corporate actions and focusing on a specific scenario, the reverse stock split. Imagine a company, let's call it Techco, struggling with a stock price of just $2 per share. They announce a 1-for-5 reverse stock split. So Taylor, what do you think? Why might a company choose this path?
Well, we talked about regular stock splits before, right? Those are usually done when a stock price gets really high to make it more affordable. This seems opposite. Is this a sign they're trying to hide something? Like maybe their stock is about to tank even more? It definitely seems like a red flag.
Not necessarily, Taylor. While a reverse split can sometimes be a sign of trouble, it's not always the case. Think of it this way. Sometimes a very low stock price can make a company look less attractive to investors. Some institutional investors, like mutual funds, have rules against holding stocks below a certain price. A reverse split can boost the share price and potentially attract these investors.
That's a good point, Sam. It's like dressing up a house before you sell it. The foundation might need work, but a fresh coat of paint can make a difference. Now, Sam, is this always a sign of financial trouble?
No, sometimes companies use reverse splits to consolidate shares after a period of decline. Imagine Techco had a bunch of shares outstanding from previous equity offerings when their stock price was higher. A reverse split reduces the number of shares outstanding, which can tidy things up, so to speak.
So if I understand correctly, if I owned 5 shares of Techco at $2 each, after a 1-for-5 reverse split, I'd own just 1 share worth $10, right? The overall value of my investment stays the same. But what about the second question Alex asked? How does this impact my ability to trade the stock? Does it become harder to buy or sell?
The impact on trading can be mixed. A higher share price might attract larger investors, increasing trading volume and liquidity. However, if the underlying financial issues aren't addressed, the higher price might be artificial, and the stock could continue to decline even after the reverse split. It's like putting lipstick on a pig, as the saying goes.
Exactly. It's crucial to remember the core business hasn't changed. Just because the price changes due to a split doesn't mean the underlying company is suddenly more valuable.
This is helpful. So a reverse split itself isn't automatically bad, but it's definitely something to investigate further. It's a bit like seeing a reduced for quick sale sign on a car. Makes you wonder what's really going on.
Precisely. It warrants further investigation. We've covered the why behind reverse splits, the potential perception issue, and how it can influence trading. It's important to remember that these splits don't fundamentally change the company's value.
To add to Alex's point, the source article emphasizes understanding the reasons behind the corporate action. In this case, you'd want to look at Techco's financials, see if they're addressing underlying problems, and consider their long-term prospects.
Excellent advice, Sam. So, listeners, the key takeaway here is to analyze the company's financials and consider the long term prospects before reacting to a reverse stock split. Don't just look at the price change, look at the why behind it. We've been discussing corporate actions and how they impact investors, and now we're going to delve into a specific scenario involving a dividend aristocrat. This term refers to a company with a long history, typically 25 years or more, of consistently increasing its dividend payouts. Imagine a well established company, a household name even, announcing its next dividend payout. This is a prime example of the kind of company that attracts long term investors. So, Sam, Taylor, let's consider the benefits and drawbacks of investing in such dividend paying stocks. Taylor, what are some advantages you see in a long term dividend reinvestment strategy, especially with a dividend aristocrat?
Well, Alex, from what we discussed earlier about corporate actions, dividends offer a regular stream of income. Reinvesting those dividends, especially with a company that steadily increases them, seems like a powerful way to grow your investment over time. It's like a snowball effect, right? The dividends buy more shares, which generate more dividends, and so on. This also reminds me of what we talked about in episode 29 about compounding. Is that the same principle at work here?
Exactly, Taylor. Dividend reinvestment harnesses the power of compounding. It's a long-term growth strategy. Think of it like a tree bearing fruit. You can eat the fruit, take the cash dividend, or plant the seeds to grow more trees, reinvest. With a dividend aristocrat, you're essentially planting seeds in fertile ground, given their track record of increasing the fruit they produce each year.
That's a great analogy, Sam. Now, another important aspect of investing is diversification. How does dividend income, specifically from these reliable dividend aristocrats, factor into a well-diversified portfolio, Sam?
Dividend-paying stocks, particularly dividend aristocrats, often represent well-established companies in stable sectors. They can provide a ballast against market volatility and contribute to a more balanced portfolio. However, it's crucial not to over-concentrate in any single stock or sector, even if it's a dividend aristocrat. Diversification across different asset classes remains essential.
So, if I understand correctly, having some dividend aristocrats in my portfolio could provide a steady income stream and help reduce risk, but it shouldn't be my only investment strategy.
Precisely, it's one piece of the puzzle, not the whole picture.
Excellent point. Now let's turn to a practical consideration. Taxes. What are the tax implications of dividend income, Sam?
Dividends are typically taxed as ordinary income unless they're qualified dividends. Qualified dividends are taxed at a lower rate, similar to long-term capital gains. The qualifications depend on factors like the holding period and the company's status. It's always a good idea to consult a tax professional for specifics.
This reminds me of something from episode 30 about market mechanics. We talked briefly about different tax brackets and how different investments are taxed. So, while dividend income is generally good, the tax implications can vary depending on the specifics.
Absolutely, Taylor. That's a critical point. So, let's recap. Dividend reinvestment, particularly with dividend aristocrats, offers a compelling way to leverage the power of compounding for long-term growth. These stocks can play a valuable role in portfolio diversification, but they shouldn't be your sole investment strategy. And finally, understanding the tax implications of dividend income is essential for effective financial planning.
This has been really helpful. I'm starting to see how dividend-paying stocks, especially the dividend aristocrats, can be a useful part of a long-term investment strategy.
Great, Taylor. As a call to action for our listeners, when considering dividend-paying stocks, particularly dividend aristocrats, carefully evaluate your individual income needs and investment timeline. These stocks can be a powerful tool for building long-term wealth, but it's crucial to consider them within the context of your overall financial goals. We've been discussing corporate actions and their impact on investors. Now we're diving into a specific scenario, the special dividend surprise. Imagine opening your brokerage account and seeing an unexpected dividend payment. That's a special dividend, a one-time payout outside the regular schedule. So Sam, let's start with the why. Why might a company issue a special dividend?
Several reasons, Alex. Sometimes it's a way to distribute excess cash that the company doesn't immediately need for operations or reinvestment. Think of it like a really good year for a bakery. They might decide to give back some of those extra profits to their owners. Other times, it could be due to a one-time event, like the sale of a business unit. It can also be a strategic move to boost shareholder value, especially if the company believes its stock is undervalued.
So if I understand correctly, it's not like the regular dividends we talked about in the last episode, the ones paid out consistently. This is more of a bonus?
Exactly, Taylor. Think of it as a bonus. Remember how we discussed cash dividends and how they are a portion of the company's profits paid out regularly? A special dividend is different. It's a one-time thing.
So if mergers and acquisitions happen, could a special dividend also be a way to distribute proceeds from a merger or acquisition before the actual integration happens?
Excellent point, Taylor. Absolutely. A company might use a special dividend to distribute some of the gains from a divestiture or asset sale. It allows them to share the immediate benefit with shareholders while they figure out the long-term strategy.
Let's move on to our second question. How should investors interpret this event? Sam?
A special dividend can be viewed positively or negatively, depending on the specific circumstances. A large, unexpected special dividend might signal strong financial health and good management. However, it can also suggest a lack of profitable investment opportunities, meaning the company doesn't see internal projects worth investing in.
That's interesting. So it's not always a clear-cut win. It really depends on the why behind the dividend. What if a small, struggling company issues a special dividend? Could that be a red flag?
Good question. In that situation, it might raise concerns. It could be a desperate attempt to appease investors or a sign they're running out of options. That's why it's crucial to research the reason behind the dividend.
That brings us to our final question. What factors might influence the market's reaction to the announcement?
Typically, the stock price tends to adjust in proportion to the dividend amount. Let's say a company's stock trades at $50 and announces a $5 special dividend. You might see the price drop to around $45 after the ex-dividend date, the date by which you must own the stock to receive the dividend. This is a natural market correction.
So, it's important to remember that the total value to the shareholder doesn't actually change immediately around the ex-dividend date, because you get the $5 dividend in cash if you held it on the correct date.
Precisely. It's important not to panic if you see a drop like that. It's a technical adjustment. The overall market reaction also depends on the reason behind the dividend, as we've discussed, and the company's future prospects. To wrap up, special dividends can provide valuable insights into a company's financial health and strategy. While they often signal positive news, it's essential to research the reasons behind the payout. Remember, a special dividend is not just free money, it's a piece of a larger puzzle.
It definitely seems like more research is needed when a special dividend is announced.
Absolutely. So, listeners, our call to action today is to take some time to research any special dividend announcements from companies in your portfolio. Consider the potential impact on your individual investment goals, and as always, consult with a qualified financial advisor if you have any questions. Let's explore mergers and acquisitions in our next scenario, the mega merger. Imagine two giants in the same industry, let's call them Alpha Corp and Beta Inc., deciding to join forces. We're going to unpack the potential ripple effects of this kind of mega merger, from synergies and risks to the impact on shareholders like you and me. Sam, Taylor, ready to dive in?
Definitely, Alex. This reminds me of what we discussed earlier about corporate actions, mergers being one of the big ones, right? A mega merger sounds like it could be a game changer.
Precisely, Taylor. And as with any corporate action, understanding the implications is key.
Exactly. So, Sam, what are the potential benefits and drawbacks of this kind of merger for Alpha Corp and Beta Inc.?
Well, a primary driver for mergers is synergy, the idea that the combined entity is worth more than the sum of its parts. This could come from cost savings by eliminating redundant departments, increased market share by combining customer bases, or even accessing new technologies or markets. However, mergers can also be risky. Integration challenges, cultural clashes, and regulatory hurdles can derail even the most promising combinations. Sometimes, anticipated synergies just don't materialize.
So if I understand correctly, it's like baking a cake. The right ingredients combined can create something delicious, but if you mess up the proportions or baking time, it could be a disaster?
That's a great analogy, Taylor. And thinking about the industry as a whole, Sam, how might a mega merger like this impact competition?
It depends. A merger can reduce competition, potentially leading to higher prices for consumers. Regulators often scrutinize these deals closely to ensure they don't create monopolies. On the flip side, a merger can sometimes create a stronger competitor, driving innovation and benefiting consumers in the long run. Take, for example, the merger of Exxon and Mobil. Individually, they were large companies, but combined, they became a global energy powerhouse.
This makes me think about the recent articles I've seen about airline mergers and their potential impact on ticket prices. It's a real-world example of how these decisions can have a direct effect on consumers.
Absolutely. Now let's shift our focus to the individual investor. Sam, what should investors consider before, during, and after a merger like this is announced?
Before the merger, investors in both Alpha Corp and Beta Inc. should carefully review the terms of the deal, including the exchange ratio for shares. During the process, stay informed about regulatory approvals and any potential changes to the agreement. After the merger closes, monitor the performance of the new combined entity, paying attention to whether the promised synergies are being realized.
So, to recap, we discussed the potential synergies of a mega merger like the one between hypothetical Alpha Corp and Beta Inc., along with the inherent risks involved. We also explored the potential impact on industry competition and outlined some key considerations for investors at each stage of the merger process.
So, this is different from a stock split, where my total investment value stays the same, but I have more shares, right? With a merger, the value of my shares could actually change based on how successful the combined company is.
Exactly, Taylor. And remember, the context we discussed earlier about corporate actions really comes into play here. Mergers are a significant event that can reshape your investment landscape.
Great point, Sam. To wrap things up, our call to action for this episode is simple. If you hold stock in companies involved in a merger, take the time to review the merger terms and assess your investment strategy based on the potential outcome. Don't hesitate to consult with a financial advisor if you have any questions. We're continuing our discussion on mergers and acquisitions, and now we're diving into a particularly dramatic scenario, the hostile takeover. Imagine a smaller, promising company suddenly becoming the target of a larger corporation wanting to acquire it, but against the wishes of the target company's management. This, Taylor, is what we call a hostile takeover.
So, it's like a corporate raid? Sounds intense. I remember us talking about mergers and acquisitions generally in the previous segments, but this seems less friendly. What happens in these situations?
Exactly. It can be quite a battle. Sam, can you shed some light on what strategies a target company might use to fend off such an unwanted advance?
Certainly. Several defense mechanisms can be deployed. One common tactic is the poison pill, where the target company makes itself less attractive to the acquirer, perhaps by issuing new shares to existing shareholders, diluting the acquirer's stake and making the takeover more expensive. Another is the white knight strategy, where the target company seeks acquisition by a friendlier company.
A poison pill? That sounds almost, well, poisonous. Can you give me a simple example?
Imagine a lemonade stand being targeted by a larger juice company. The lemonade stand could suddenly issue a bunch of coupons to existing customers, so that if the juice company buys the stand, they now have to honor all these discounted lemonade offers, making the purchase less profitable.
That's a great analogy, Sam.
Right. So if I understand correctly, the goal is to either make the target company too expensive to acquire or find a more preferable acquirer. That makes sense. But what about the shareholders? Where do they stand in all of this? How can they protect themselves?
Excellent question, Taylor. Sam?
Shareholders of both companies are impacted. The target company's shareholders might see a premium on their shares as the acquirer offers a higher price to entice them to sell. However, they also risk losing potential future gains if the target company was on a strong growth trajectory independently. The acquirer's shareholders, on the other hand, might see their shares decline if the market perceives the takeover as a risky or overpriced move.
And this is where due diligence becomes crucial. Investors need to analyze the offer, the companies involved, and the potential outcomes.
This reminds me of what we discussed about researching companies before investing. It applies here too, doesn't it?
Absolutely. It's even more critical in a hostile takeover situation.
Okay, so strategically trying to defend potentially better offers for shareholders, but also risks involved. What about the ethics of all this? It seems quite aggressive.
The ethical considerations are complex. Some argue hostile takeovers are a legitimate market mechanism for correcting inefficient management and creating value. Others view them as predatory, disrupting stable businesses and potentially harming employees and communities. It really depends on the specific circumstances.
So, we've looked at the strategies involved, the impact on shareholders, and the ethical complexities. Let's recap. A hostile takeover is when one company tries to acquire another against the wishes of its management. Target companies can use tactics like poison pills or seek white knights. Shareholders on both sides can be impacted, often seeing increases or decreases in share value based on market perception. Finally, the ethics of hostile takeovers are a subject of ongoing debate.
This has been really helpful in breaking down a complex situation. I definitely see how understanding corporate actions, like we talked about earlier, is so important in navigating these situations.
Exactly, Taylor. As a takeaway for our listeners, if your investment is involved in a hostile takeover, monitor the situation closely, understand your rights as a shareholder, and don't hesitate to seek professional advice if needed. This can be a very complex and volatile situation, and ensuring you understand what's going on can help protect your investment. And that concludes our deep dive into the world of corporate actions. We explored how decisions made by companies, from stock splits and dividends to mergers and spin-offs, can directly impact your investments. Just like the text emphasized, staying informed is key, so remember those action steps, like reviewing your broker's notification settings and keeping good records. I think our discussion on the mega merger scenario was particularly illuminating, highlighting the complexities and potential risks involved in such major corporate restructurings. And of course, the hostile takeover scenario really brought home the importance of understanding your shareholder rights. Thank you so much for lending us your ears today. We truly appreciate you being a part of the Safe, Simple, Sound community. Be sure to check out the show notes for links to further resources and transcripts from today's discussion. We'd also love to hear your thoughts. Leave us a review and let us know which scenarios resonated most with you. And don't forget to subscribe so you don't miss our next episode, where we'll be tackling the fascinating world of market cycles. Until then, stay informed, stay safe, and stay sound. This is Alex signing off.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at safesimplesound.com. If you would like personalized guidance, you can reach out to us at safesimplesound.com/contact. Until next time, take care and bye for now.